call this ARMR education. Understanding where we are in the cycle. This is the ARMR Investing Way. Everything we do here begins and ends with the risk monitor. 80% of stocks follow the market. So we have to figure out the direction of the market from a swing standpoint. Where are we in that cycle? What wave are we on? Before we ever think about committing new capital to new ideas, we've got to know where the market is in the cycle so we can understand the risk we're taking. So we have 10 indexes that make up the risk monitor. When all 10 are saying the same thing, the suggestion is that institutions are moving en masse. The only animal that can make all 10 indexes do the same thing at the same time are billions of dollars of institutional capital. We've got to understand that direction. The reason is simple. Institutions don't put billions of dollars to work in one day. They're not looking at a portfolio. You might be running $1 million. You're managing $1 million portfolio. You could put all that money to work in 5 minutes if you want in this market. You can't do that as an institution. So institutions are looking out ahead. They figure out what their strategy is going to be, and they say, okay, we're risk on. I mean, did you ever think to yourself, why does the market go into an uptrend? It goes into an uptrend because institutions keep committing cash. They convert their cash hoard into investments. This is what drives stocks up. And when you're running billions of dollars, you can't do that in one day. It takes you weeks, sometimes months. So they're projecting out into the future what they think is going to happen, right? The market tends to look out ahead 6 to 9 months is the basic, type of rule of the law, right, of this land. Market looks out 6 to 9 months. That's why there's all this research. That's why all these trading desks have all these analysts. They're trying to figure out, okay, what's our plan for the next 6 to 9 months? And if that's working, we'll keep adding to it, whatever. And they commit. So our job is to witness, to watch, to monitor their movement, the risk monitor. And when we see them all doing the same thing at the same time, probabilities are real high that that trend's going to continue for a while. And so because we're faster at moving than they are, we can commit capital and ride the wave they create. That's what the risk monitor is all about. So let's go over the ARMR Investing Way step by step so we can understand where we are now in the cycle and what that means for our activities. So let's begin with risk monitor red. Let's start there. We have 3 portfolios I'm going to go over with you. ARMR Macro, ARMR Invest, ARMR Flagship. ARMR Macro only invests in indexes, index ETFs, and we buy double the indexes. It's a pure swing trading system. When the risk monitor goes from red to green, 100% of that capital gets put to work in double the indexes. So we got 200% exposure from the beginning of the red to green cycle. Risks are high when you go from red to green. That first move, there's no guarantee. This isn't a crystal ball. Institutions can look like they're putting money to work and then they can reverse. So this is a probability algorithm. Risk monitor red to green, probabilities are high, market's going up from here. And we want to make sure we get market plus returns, right? We don't want to go buy a bunch of stocks that go down when the market's skyrocketing. So at the beginning of that switch from red to green, we overweight, double the indexes. So macro is always goes from cash to 100% long when the risk monitor goes from green to red. ARMR Invest begins to put capital to work in individual stocks. And we lean into bigger cap stocks. So that if the market's going up, we're buying the big cap leaders that are driving the market up. And we might have some innovation, some innovative growth, the leaders, the first ones to break out. And we might have some dividend stocks we're buying, some turnaround stocks we're buying. Those are our investments. The flagship fund, when we go from red to green, generally will have 50% of the capital committed to double the indexes, which will give us 100% exposure to the market. We want to make sure we make money at the beginning of that turn if the indexes keep moving higher. And then we take the other 50% of the capital and begin adding ARMR Invest ideas, which again can be, at that stage, we're going to lean into leadership big cap names, leadership innovative growth, and other names on our whiteboard that could be turnaround stories, could be dividend stocks, whatever. And we're going to come up with a portfolio of stocks we're comfortable with at that point in the cycle. Okay? So that's risk monitor red to green. The next step, risk monitor's green for a while, and risk monitor goes yellow. What do we do at that stage? We've already had a rip. Risk monitor goes yellow. The macro fund cuts positions in half. So we go from 200% exposure to the market to 100%, right? We have 100% long, double the indexes. Now we only have 50%. We're taking the cream off the top there. In the ARMR Invest portfolio, we're booking profits at targets if we haven't already done that. We're raising our stops, and we're removing lagging positions. In other words, you put positions on, the market ripped higher, and those positions didn't go anywhere. Chances are that laggard's got a problem. Tidy up the portfolio. Focus on your strengths. Raise some cash. And the flagship fund at that point, 0 indexes. We take all of our index positions out when the risk monitor goes from green to yellow. We book our swing trading profit there, raising a lot of cash quick. And then we, of course, look at our investing positions, our ARMR Invest positions, and we follow whatever strategy is necessary, booking profits at targets, raising stops, getting rid of laggards, that type of thing. If the risk monitor then flips back green, yellow to green, what that really means is we had an initial rip, then a consolidation that didn't get ugly. So there's no risk monitor red, it's consolidation. Now we're breaking out again. When that happens, macro goes from 50% to 100% invested in indexes again. It's easy. It's just swing trading the indexes. We have 10 of them. So we might have different exposure at different times. And usually when we go from yellow back to green, we're going to overweight small caps, maybe the Dow. We're going to do some things in macro that maybe we avoided at the beginning of the turn. When we go from red to green, we overweight big cap tech, NASDAQ 100, QLD, SSO. Maybe we own momentum at that point. We want leadership. When we go from yellow to green, which is a consolidation, and then back on the rip, we're going to open up a little bit. We're going to pick off some positions that haven't caught up to the big cap stocks yet, small cap, Dow, stuff like that. So that's going to be ARMR Macro when we go from yellow back to green. ARMR Invest is going to take the cash in the portfolio and lean into innovative growth, smaller cap stocks, concept stocks. Because at that stage in the cycle, the market's getting more aggressive and the alpha shifts. So the leadership continues to go up, but at a slower pace. And some of these other names further along the spectrum of risk start to pop off and explode higher. And we want that alpha. And of course, the flagship fund at that stage, the flagship fund from yellow to green, does not own indexes. We don't have an allocation to macro at this point because we want to lean into the alpha generation of innovative growth, concept stocks, and also the next round of big cap tech leaders that might not have performed yet. They didn't have a big run at the beginning. And we're going there because institutions that missed the first move, anybody who missed the first move from red to green is looking for ways to put money to work. So they're going to run into stocks, big cap, that have underperformed. Bang! And that's where the alpha is. Okay? And then, of course, the risk monitor goes from green to red. And the process starts all over again. ARMR Macro goes to 100% cash. A note. When I say 100% cash, cash and equivalents to me. The equivalents are treasury bills, of course, which kind of is cash. But don't forget, I put treasury bills in there and collect yield. Gold and silver. Those are assets that don't follow the risk monitor. In fact, sometimes they go the exact opposite of the risk monitor. They're perfect hedges. Right now, gold and silver are going up with the market. That's for another time, that conversation, okay? So gold, silver, treasury bills, cash, money market funds, macro will be 100% there when the risk monitor goes from green back to red. And ARMR Invest will book profits at targets, raise stops aggressively. So we'll start raising cash, but we might still have, 25% of that portfolio still long at the end of the day because we have long-term positions in the portfolio with huge gains and we're trading around the core. So we've reduced the size, but we're holding a core for long-term capital gains. And the stop hasn't been triggered yet, right? So we're using lenient stops, weekly stops, and we're letting those positions mature. That's the cycle of the ARMR Investing Way. Everybody have a wonderful trading session. I hope you found the information helpful today. At the end of the day, whatever I'm saying, this is my strategy. I'm sharing it with you. It's how I run my capital for others. But please think for yourself, make your own decisions, and be the smart money.